Well, thank you everyone for joining today. For those of you I don't know, my name's Nathan Davis. I'm our Chief Investment Officer here at Aspen Wealth Management, responsible for running our investment committee and then a lot of our portfolio work as well. And so our quarterly market updates and forecasts have naturally fallen to me. What we're going to talk about in our meeting today is following the format of a quick review of just from a numbers perspective, what happened last quarter, what happened in equity markets, what happened in fixed income markets. A lot of the trends from the first half of the year of 2023 persisted through the third quarter. It's been a much different year this year than it was in 2022. A lot of those early year trends have kept up until where we are today. We're going to look a lot at relative valuation measures for equity markets, a little bit in fixed income markets as well, just to provide some context of where we are today relative to history and what that might mean for the future. We'll go through an economic update. So, the economy and the stock market are not the same thing. They don't always perfectly align. And so we'll look at some trends for inflation, trends for interest rates. Interest rates have really, for these quarterly webinars, interest rates have been the biggest focus point, the biggest talking point for the last 18 months, coming up on almost the last 2 years as the Fed has been raising rates pretty rapidly in that period of time. We are going to talk about recession and, are we ever going to have one again? What is the likelihood of it? Where are the possible indicators today? Either ones that are present or ones that aren't, and what that might mean for the possibility of a future recession. And then we're going to wrap it all up with what to do with that information. What are the implications for investors? We will talk about our portfolio management considerations based off of all of that macroeconomic data. And then we will wrap it up with what I call our shopping list. It's what we are looking at today from a research perspective that we don't need today, but we might need 12 months from now. That we want to make sure that we're ahead of the curve in identifying everything that's out there. So I like to always keep these presentations in context where it's important to know the data. It's important to review it. It's important to know the considerations for it for the future, but it largely doesn't impact our investment philosophy on a day-to-day basis. We have an investment strategy for a reason. The reason we have an investment strategy is to not make changes to it when short-term market events occur. So all of this data that we're about to talk about, keeping it within the context of our actual investment philosophy, we believe in a disciplined approach regardless of market conditions. That's having a strategy and making sure that you stick to it even when markets aren't looking great. We have a research-driven, grounded in academia philosophy. We want to be globally diversified. We want to be cost-conscious. There's a wide world of investable assets out there. We just want to own all of them in some degree if possible. Our investment philosophy is goals-based. We want to help engineer your portfolio's long-term success. And then we have a dual risk mandate. So we emphasize financial planning first before we ever manage investments for anybody. And by having that dual risk mandate, not only is a client's willingness to take risk an important factor, and that's you took a risk tolerance questionnaire. You said, oh, if your portfolio goes down 20%, how would you feel? Would you buy more? Would you sell? All of that is willingness. But by having completed a comprehensive financial plan for all of our investment management clients as well, it gives us the ability to look at their ability to take risk. How secure is their financial plan? How close are they to reaching their long-term goals? All of that. Moving on to the actual numbers for the quarter. So this is short-term returns, just looking at the third quarter of 2023. We had been on a good upward trend for the year, and across all asset classes, we saw slight reversals compared to the upward trend that we started the year with. These all feel pretty slight compared to last year. The broad U.S. stock market, that's represented by an index called the Russell 3000, represents all 3,000 publicly traded companies in the United States, was down a little bit over 3%. International developed markets underperformed by just a little bit, still relatively close in the grand scheme of things. Developed international markets were down 4%, and emerging market stocks, so the Indias, the Chinas, the South American countries, led the way by only being down just under 3%, down 2.93%. Real estate is continuing to struggle on a global level, and that is largely impacted by interest rates, just like the next column here for the U.S. bond market is also heavily impacted by interest rates. The U.S. bond market just in the third quarter was down a little bit over 3%, which we will talk about quite a bit in some of our upcoming slides, where the Federal Reserve has drastically slowed down the pace at which they are raising rates. But there's a lot more to market rates for bonds, for treasuries, for corporate bonds. There's a lot more to what those market rates are than just what the Federal Reserve is doing. So the U.S. bond market was down a little bit over 3% for the quarter, and the global bond market held up a little bit better. It was down, but only slightly, about 80 basis points. Zooming out just a little bit, starting with the last year, so that's the last rolling 12 months. This is where things start looking pretty good again when you take it, at least in the context of the last year, and then beyond here to say, hey, investing is about a lot more than just the most recent quarter. For the last 12 months, the U.S. stock market is still up over 20%. Developed internationals are up right at 24%. Emerging markets are lagging, but they're still doing better than being down. They're up a little under 12%. Global real estate has held on to be up 2% for the last year. And what's interesting is that it was a tough 2022 for bonds. It was a tough quarter for bonds. But now those bonds over the last year are very close to just breaking even. Again, we'll talk about that a lot more in the upcoming slides. Zooming out even further, so these are annualized returns over the last 5 years, over the last 10 years. Focusing on a few of the high points, the United States is just significantly outperforming everything given a long enough time frame. So when we look at on an annualized basis, the U.S. stock market is averaging just over 9% a year for the last 5 years, which is significant because we've technically had what I call 2.95 bear markets in the last 5 years. There was 2022 bear market. There was the onset of the pandemic bear market in the first quarter of 2020. And then the very end of 2018 was also a 19.9 drawdown in the fourth quarter, where even over all of that time frame, it's still averaging 9% a year. Zooming out a little further to the last 10 years, U.S. equities are returning over 11% a year for the last 10 years, just absolutely dominating the rest of the world. Our main themes for equity markets for the last quarter, looking forward, it's very much a story of mega cap technology companies versus everything else. We do hear a lot whenever you turn on the news and the market is being referenced. Oftentimes it's the S&P 500, which is by no means the all-encompassing market. It's the largest 500 companies in the United States. But even that S&P 500 companies is largely dominated by 5 or 6 very large tech companies. And so there's a whole investment world, even just in the United States stock market, beyond those mega cap tech stocks. And if you look beneath the surface, taking that a little further, you can see that there's a lot of opportunity, there's a lot of value, there's a lot of interesting investment considerations. And then lastly, which has been kind of nice, a nice change of pace as compared to 2022, it has actually been a low volatility year. That started for the first half of the year, that has very much continued. And so our low volatility, at least intraday volatility, that trend has continued. So this first slide for kind of looking a little further back on equity markets, I always like to say is our context for being long-term investors. There's a lot of information on the slide. There's a lot of stuff going on. But if you kind of glaze over and ignore any of the data points and just look at the shape of this chart, which takes us back to 1996, you can see that it's our justification for being long-term buy and hold investors. That chart goes up and to the right, which means that we are gaining value over time. We are seeing growth. When you look at any individual years, the shorter the time frame, the more likely it is that you see volatility, that you see losses, that you see drops in price. But just kind of glazing over all of the numbers that are on here, looking at the shape of this chart, looking at the time frame in which it's invested, you are rewarded by holding stocks in the long term, if you can avoid making decisions around short-term price volatility. What we're going to talk about a lot in the next couple of slides, you'll see referenced on here PEs, which is a price to earnings ratio. It's the price of stocks today divided by the forward estimate of their earnings, which is those companies, or the aggregate of companies' net profitability. We're going to come back to this after the next slide, but it is a metric for saying, hey, is our market expensive? Is our market cheap? You will see that thrown around a lot when you turn on the financial news and say, hey, is it a good time to be investing right now? Should you be concerned? Should you buy? Should you sell? That is a metric that's discussed a lot. Diving into that a little bit further. So as we said, PE ratios, price to earnings, it's saying, hey, if today's prices are a reflection of some current knowns, those current knowns being of these stocks that we're investing in, what is the current state of their balance sheet? Do they have a lot of cash? Do they have a lot of debt? How are they operating as a business today? It's a reflection of their current earnings. What are their revenues? What are their profit margins? What kind of earnings are they delivering to investors today? And today's prices are also very much a reflection of future estimates of unknowns as well. Mostly being, well, these future earnings that are driven by future growth. We don't know what they're going to be, but we've got estimates of what they might be in the future. And so when we look at these price to earnings multiples and what that means for the price today and what we could hope for future returns, it gives us a metric to help benchmark and compare the value of a stock, the value of the market as a whole, as opposed to just the price. And when you compare to history, you compare to current peers, it at least just gives us a frame of reference. And so what this tells us is, how much are you willing to pay today to buy future cash flows, to buy future growth, for these companies, for these markets, for these index funds that we're investing in. And what we can see here is that overall, we're not too far off of the historic average, especially if you look back to the beginning of 2018. We've seen some lows where, hey, markets dropped and they were very, very cheap. The price that was being offered up for our expectations of future earnings was pretty low. That's usually pretty attractive. We've seen very much relative highs that were way above norms that said, hey, earnings estimates haven't changed much. We don't think that all of these companies are going to earn that much more in the future. They're not going to be able to, put that money back through dividends or growth back to investors. You're just paying a whole lot more for it. And we've seen everything in between. And so when we look back at what all of this means, as we look through PE ratios, it's a good thing to keep in mind when we're investing in everything, we're owning the entire market, and we are potentially looking at what kind of tilts or what kind of over allocations we want to have in our portfolio. But there is by no means the only basis for decision making. Actually looking into some of these numbers right now, in 12/31/1996, going all the way back to the beginning of our chart here, you could expect to pay 15.9 times future earnings as the valuation. And all of that ties back to, hey, what's the level of our market being the S&P 500? At that point in time, the S&P 500 was at 741, so considerably different than it was today. That date, so December 31st, 1996, with that price to earnings multiple, saw 106% subsequent return until we got to March 24th, 2000, which was effectively the start of the dot-com bubble burst. To again use a frame of reference, to use a benchmark, the price to earnings multiple at that point in time was just over 25. So prices were much higher as determined by the level of the S&P 500. And a contributor to that was investors being willing to pay more per dollar of earnings than they were previously. Looking at some of the next steps that we see here in what was the beginning of the lost decade, early 2000s to late 2000s, for a 15.1 PE at the start of the Great Financial Crisis. Well, there was also a 15.1 PE earlier at the beginning of 1996. So what happened? What happened after each of those periods? Well, at the beginning of 1996, we paid 15 times earnings to get into the market, and we earned 106%. And on October 9th, 2007, we paid 15 times earnings to get into the market, and we subsequently lost 57%. And so keeping all of it in context, it is not the one decision-making factor, but it is important to at least give context to where markets are today. Give an idea of what prices are, and is it fair? Is it a good value, or is it a poor value? It gives context for all of that overall. Taking that into the rest of our conversation for, hey, the equity market is largely being driven by these very large companies. 3,000 publicly traded companies in the United States, and it's effectively 7 tech companies that drive seemingly all of the market returns of the S&P 500. Lately, though, the large companies are contributing a lot to the P side of the equation, and they're contributing way less to the relative E side of the equation. And what that means is that they're contributing a lot to the price. They're currently 32.7%, top 10 stocks, 32.7% of the S&P 500. But they're only at 19% of the earnings contribution to the S&P 500. So what that translates to is that they've had a good run. They've had a lot of ups and downs. They've had an earlier bear market that started mid-2021, way before everything else really started selling off. But what that tells us is that we need to look outside of just these really large companies. They're expensive relative to their earnings. That has been a good thing for contributing to the price improvement over the last year or so. But we also really care about earnings as we're heading into potential recession in a year and 2 years. And we just want to be more mindful of that today than ever before. Also important to know, we talked on the other side, the lost decade and the dot-com bubble burst. The PE ratio was 43 for the top 10 companies in the S&P 500 versus 29 times today. So overall, this seems high relative, hey, just relative to the average, just where we are today. It seems like those top 10 companies are overvalued, but by no means catastrophic market events coming up anytime soon that would repeat the 2000 tech bubble or the Great Financial Crisis. By no means any indicator of issues quite like that. To provide a little bit of additional context to it, this is the dispersion of value metrics across the 100 largest companies in the S&P 500 and the 100 smallest companies in the S&P 500. So company 1 through 100 and companies 401 through 500. We can see that the average of those price to earnings multiples, the average of that attractiveness of purchase price today, is really not too far off of the average. It's a little bit high compared to the average. 25-year average is at a little over 16. We're at 16.6 currently. But what is very interesting is the spread between those. What's the relative valuation of companies 401 to 500 to the largest company to companies 100? And that is a difference of almost 14 times earnings. And so that's where when you're looking at something down here that has a 10 times multiple from a price earnings perspective to something that's up around 25, looking at, you isolated just the top 10, as we said, that's looking closer to up here, the closer to 30 above 25. It just paints a really interesting picture for when you look at the S&P 500 and only the S&P 500 is one collective number. There's a much larger conversation in the underpinnings of that. Not to mention that that's still just the largest 500 companies. There are 2,500 other publicly traded stocks in the United States that exist outside of this. And it just further lends to that story on looking for value as we head into potentially troubled times if we enter into a recession. What this shows us here is valuations by various styles. On the left-hand side is our actual numbers for what is our price to earnings ratio today, what is our average price to earnings ratio. And you can see that when we look at small value side of the market, they're trading well below their averages, 13.1 today relative to an average of 16.7. And you compare that to the opposite end of the spectrum, which is very large, very expensive growth companies like those top 7 mega tech companies in the United States, and they're trading well above historic 20-year averages. And so there's a lot of investment world that exists outside the S&P 500, and particularly outside the largest 7 tech companies, largest 10 companies in the S&P 500 that drive so much of the return of the S&P 500. That we're really wanting to be mindful of. Moving past valuation multiples, this has been nice. Volatility is easing. So I actually didn't even have to change this slide at all from last quarter because there have been 2 days of plus or minus 2% trading days so far the entire calendar year of 2023. Those 2 days occurred in the first month of the year. And then every single quarter since, there has still only been 2 plus or minus 2% trading days in the calendar year. As you can see, last year was considerably different. There were 46 plus or minus 2% trading days, evenly split. 23 days were plus 2% or more. 23 days were minus 2% or more. And this year has relatively been much quieter. On the right-hand side, and just like with all of these things, whatever happened in the past with these types of years is very much no guarantee or indicator of what's going to happen in the future, but just to provide some context around it, historically, when there are 10 or less plus or minus 2% trading days in any one given calendar year, the average return of the S&P 500 is a little over 17%. Historically, what happens is that in good market years, the intraday volatility, so whatever the market moves in any one given day, is considerably lower. So it doesn't move a lot in any one given day, but over the 250 trading days of the year, they just tend to add up. All of those small wins tend to add up. And in bad market years, it tends to be a little bit of the reverse, where you see a bunch of large negative, panic days, down 2%, down 3%, where a lot of the other days are flat or you see minor gains. But in years like this, and at least in the past, when there's been low volatility, no one given trading day is swinging wildly from a price perspective, it tends to bode well for the market overall, at least from a calendar year perspective. So moving on to fixed income markets, interest rates have increased across all maturities. That has very much held constant for the last 18 months that we've been doing these presentations. The yield curve inversion steepens, just means that the short end of our yield curve, 3 months, 1 year, are paying us a little bit more than all of our other maturities, which is abnormal. It's been that case for over a year now, but historically that is abnormal, and it does indicate some kind of strife going on, some kind of abnormal conditions. Overall, market dynamics remain attractive. We'll talk on that, and that's kind of just like relative valuation, like we were just talking about for equities. That's relative valuation for bonds. Same concept holds in a slightly different way, but for the bond market, And then it does, well, I'm not officially calling an end to it or trying to predict when it'll be or what our final Fed funds rate will be. There is just no denying that we are at or near the end of the Fed's hiking cycle, which is good because it's been a long 18 months or so since they've been hiking interest rates. Looking at the Fed funds expectations, so again, I do feel pretty confident that we're near the end of the tightening cycle as they're raising rates. Cumulatively, the Fed has hiked 5.25% over the last 18 months. Historically, that had never really been done before. Rates have been hiked 5% or more, but just not in such a short time frame. Historically, it had taken years to get hikes that were at that level. That's why 2022 was a little bit unique. The most recent meeting that they had was in September, and they chose to leave the rate unchanged. They do have two more meetings coming up. One on Halloween, then they'll be meeting again mid-December, December 12th. On average, the average member of the Federal Open Market Committee, which is the Fed governors that decide what they're going to set their rate at, on average, they expect one more hike, and they expect it to be 25 basis points. So that's at least just not, still needs, we need to wait and see. It still needs to be announced. But on average, that's what we're expecting for the rest of the year. In addition to that, looking at the FOMC, so the Fed themselves, what their estimates are going forward. They think that we're going to peak in our interest rates by the end of this year. And then even themselves, they're forecasting rate cuts starting next year. The degree of their cuts, at least from their own projections and definitely for market participant expectations, which is our green here, the degree to which they will be cutting interest rates or forecasted to cut interest rates next year has declined quite a bit as well. I think that as rates were rising, people were kind of forgetting that there's not two options for what interest rates can do. There are three options. The conversation was always, when are they they're going to raise, when are they going to stop raising and start cutting? And it seems like now, finally this year, people are remembering that there is a third option, which is to just not raise or cut and just hold rates constant. And that's where you see whenever the chart is leveling off, market participants think that, hey, one or two cuts over the next 2 years, and then after that, rates holding constant around 4%. All just estimates, but it gives us some good context for making decisions as it pertains to our bond allocation for sure. And last thing, interesting. So whenever you turn on the news and they say, oh, bond market did this, and here's why we think it is, investor attention is going to be flipped now going forward. Up to this point, it was always, how much are they going to raise it by? Are they going to raise it? When are they going to stop raising it? And now they're going to be having the exact same conversations on the news, but it's all going to be about rate cuts. When are they going to cut? What are going to be the extent of the cuts? How long are they going to cut for? I don't see us getting a break from people trying to forecast what the Fed is going to do going forward. The possibility of a recession is very much has the ability to change actually how the Fed responds with their interest rate strategy at the end of 2024 through the end of 2025. If a recession does occur, pretty reasonable to expect that the Fed would cut rates pretty rapidly. They rose them, they increased them pretty rapidly last year. Pretty good indication that they would try to save our country from a recession by unwinding that to a large degree and cutting rates rapidly. Both scenarios. If a recession is avoided and the Fed may deliver some mild cuts next year, that mild is generally described as 1% or less. Hey, they're going to get us to the high fives. Maybe they'll give us a little bit of a break as consumers and cut us back to the high fours, something like that. If a recession is avoided completely, which would be the first time in history after a rate hiking cycle like this, mild cuts could occur. Both scenarios overall, whether a recession happens or doesn't happen, whether there are mild cuts, whether there are steep cuts to interest rates, both scenarios bode well for high quality fixed income investments overall. Here's a look at the Treasury yield curve as it is today. The inversion has continued to steepen. When we talk about the inversion, that's this side of things. Pointer froze up on me a little bit. Where at the front end of the curve, rates are actually higher than they are in the middle to the end of the curve. Traditionally, with what you see on the bottom, which is December 31st of 2021, end of the calendar year before they started raising rates, we see an upward sloping yield curve. The longer that you are dedicating your money to lending it to the Treasury, the more you can expect to receive back for it. That at the bottom is a normal looking curve, albeit a very low curve. I don't think that rates will ever get back to as low as they were, well, not ever, at least not in the next 2 years, get back to being as low as they were in December of 2021. But the shape of the curve very much will work its way back towards that over time. The nature of how exactly that's going to play out still remains to be seen. What we can expect is that this part of the curve has started to widen a little bit relative to the short end. Oh, there we go. There's my pointer again. So that is the early process of this curve going back to a normal shape. If this part of the curve here all rises and this one holds constant, that gets us much closer to a normal shape. Or if the Fed starts cutting rates, this short end of the curve will be the first to be impacted, just like it was when the Fed started raising rates. And likely what normalization of our yield curve will look like is the Fed at some point in time starting to cut rates a little bit. We'll see our front end start to come down. We'll see the mid to the back end kind of continue to tick up, just as the lagged effect of all of these raised interest rates actually impacts the longer end of the curve and works us back towards a more normal yield curve. Looking beyond December 31st of 21, December 31st of 2022, and then where we are today, it doesn't tell the whole story because those are some pretty wide dates for the most part. Looking at year to date, each of these rates that make up the curve. And so a lot going on here, but to give the general high view of what we have going on, this is each of the individual rates, 3 months, 1 year, 2 year, you can kind of see them listed out at the bottom. And by date, the actual yield or rate that they're all paying so far year to date, seeing that, hey, there has been some interest rate volatility. When you look between the lines of our last curve of 2 points in time, if you look at all of the points in time and how each of those rates was impacted, we do start to see a little bit of a trend, and it's a trend overall that I think is positive. All of our mid to long-term rates are lower than our short-term rates, as we just kind of discussed. And so it's pretty easy to break it down that everything here is all of our more or less longer rates. And everything here is more of our shorter term rates. And where I say that we're starting to make some progress is effectively in the slope of what we're looking at here. And that is that short-term rates are still increasing a little bit, but for the most part, they're pretty flat. And everything else out to 30 years is starting to see somewhat of an upward trend. As interest rates rise, it's very possible that prices fall. We did see that when we looked at our very first slide of what have markets done in the third quarter, when U.S. bond market was down about 3.5%. A lot of it is because of this, because even though the Fed has slowed down considerably, market forces still exist on interest rates, and we're seeing that those interest rates on the mid to back end are finally starting to rise. They're finally starting to catch up. But overall, that's still a good thing for investors. The period of going from lower rates to higher rates, or just any period where rates are rising, in the short term, that can be a little painful from a price perspective, but it pays dividends in the long run, pays interest in the long run, many times over, because being an investor, being a net, buyer of interest rates as opposed to a net seller, when you need to go apply for a new mortgage, this is less than ideal. But if you're lending money to, large corporations, to the federal government, and you're collecting interest in return, these higher rates are very much a good thing. It's just getting from low to high can be a little painful, but we're finally seeing the mid to back end of the curve trending in the right direction here. Looking at the relative valuation of fixed income, just like we spent all that time talking about relative valuation for equity markets, what we're looking at here is we're looking for some skew. And what I mean by that is that with where that same yield curve was on January 1st of 2022, which is on the left-hand side here, there wasn't even a consideration for what if rates rise 1%, what if rates fall 1%, because their rates were zero. They couldn't really fall anymore. So all there was, hey, what's going to happen if rates rise by 1%? And that is the interest rate risk that's priced into bonds, where the longer dated your bond is, the more price volatility that you can have. On the flip side of that, the shorter your bond is, the less price volatility. If you're comparing yields, if you're comparing interest rates that they earn, something like high yield, the higher your yield is, the more insulated you are from interest rate changes. The lower your yield is, the more exposed you are to interest rate changes. And so when we decided to make changes to the composition of our fixed income portfolio at the end of 2021, beginning of 2022, it was with this in mind, where, hey, the longer dated our bond portfolio is, there's nothing really here that looks attractive. It's just, hey, there's no like price gains to be had. It's just how far could things possibly fall from a price perspective. And so we decided to make changes to find ourselves largely here. Yeah, you still see some price drops in short-term fixed income, but you also see the fastest recovery because, as we talked about earlier, on the short end of the curve, those bonds start receiving higher interest rate payments faster as rates rise. And so this is where you want to be. We have come a long way in what is now 20 months to, well, there's some skew here. What if rates rise by 1%? What if rates fall by 1%? And what we can see that even if interest rates continue to rise by 1%, the price drop in these bonds is considerably different than it was on January 1st of 2022. At that point in time, it's forecasted that, hey, if rates were to rise by 1%, your 30-year treasury would be down about 20. Where we are today, now that rates have had a chance to come up, now that rates are higher than they were on January 1st of 2022, that same 1% rise in interest rates still very much impacts bonds. The 30-year treasuries would be forecasted to be down 11%, but that's a pretty considerable difference from where we were on January 1st of 2022. Not to mention, there's a second side to this line now that didn't exist before, that if we buy 30-year treasuries in any regard, we could expect rates could also fall by 1%. And if rates were to fall by 1%, it would, just from a interest rate roll return calculation standpoint, 30-year treasuries would be set to earn 21%. And so taking the relative valuation conversation that we had with equities and applying it now to fixed income, it's given us a lot of flexibility to start moving away from where we were 20 months ago with our focus on short term, focus on avoiding losses as it pertains to rates rising and everything like that, to finally start extending back out, getting 5 years, getting 10 years, we still don't directly own 30 years in many client portfolios, just because as you can see, it's pretty volatile. That's usually not what we buy our fixed income for. But as part of our funds that we own, they average about here 10 years or less, somewhere between 5 and 10. But the funds we own some 30 years, and it's all because now we have some positive skew. I don't think it's just as likely that rates rise 1% as if they were to fall 1%. So we don't want to indicate that these are equally likely outcomes. They're still unpredictable, but I think overall it's more likely that we see a fall in interest rates from here as opposed to a rise. But now we actually have some positive returns to see in our fixed income. Rates are higher now than they were January 1st of 2022. Rates have the ability to fall from here, which they did not on January 1st of 2022. All of that translates to a relatively attractive fixed income market going forward relative to what we've had the past 20 months or so, 22 months. From an economy perspective, so overall, the economy is holding up. Recession risks remain, but the predicted likelihood of a recession is still a lot lower today than it was a year ago. It seemed a year ago that there was a high likelihood that we would be in a recession at this point in time. Try not to predict the start and stop of recessions, and we'll talk about that in a couple slides. But all things considered, the economy is still growing, unemployment is still low, despite interest rates having risen as much as they have. So recession risks remain, of course, just with how far we are into the cyclical expansion, but the economy is holding up overall. Some cracks are starting to emerge in the labor market. They exist, but I don't think that they're overly concerning, because on the flip side, there are also structural considerations in our labor market that I do think makes it pretty difficult for unemployment to rise considerably in the future. Unemployment rising is generally an indicator of an economic recession. And then we haven't had to talk about inflation as much, at least the last year. That was I don't know, early mid 2021 conversation more than anything. But inflation continues to fall gradually, very much still not to the Federal Reserve's target 2% inflation rate. Managing inflation was one of their big motivations for raising rates to begin with. Not to their target, but inflation is continuing to fall gradually, which is nice. So looking at our economic growth and some of the components of our GDP, as I said, the economy is holding up better than expected. The recession risks that remain are for a few different reasons. Easing inflation, stronger economic growth, it's fueling optimism. Hey, maybe we have a soft landing. When you hear the term soft landing, that is the summary for rates hiked. Inflation got high, the Fed hiked rates, hiking rates reduced inflation, and in the course of all of those events, we avoided a recession. That's what a soft landing means. And so the optimism for that is increasing because monthly economic data has looked good, but it's good but slowing. From a kind of bad news perspective, corporate profits are starting to slow. When corporate profits slow, that could contain growth for those companies. It could contain the growth in capital expenditures, in reinvestment. A lot of that is directly tied to capital being more expensive to attain than it was previously, now that rates are a lot higher. Consumers are depleting their savings balances, taking on more debt to maintain current spending. My rule of thumb is never underestimate the American consumer's propensity to spend. Americans love spending money. Even this is consumption. This is, the components of GDP. Consumption is 68% of our gross domestic product. It never underestimate the American consumer's propensity to spend. Americans are still spending. It's just how they're accomplishing that spending has changed a little bit. They're depleting savings that were built up during the pandemic. They're taking on more debt. And as they're taking on more debt, the delinquencies on that debt is starting to rise a little bit. Still not to historically alarming levels, but relative to the past 5 years, it's elevated. And then the one main unknown in all of this is just the continued lagged effect for monetary tightening. When the Fed raised rates as rapidly as they did in a short amount of time that they did, it's a little short-sighted to say, hey, they're about to end raising rates by the end of this year. Like, we're in the clear, we made it, nothing terrible happened. It's a little short-sighted to chalk that up to a victory without also planning for considerations of the lagged effect of that all. Okay, well, 1 year after a hiking cycle, given time for that to kind of permeate through the economy, like how's that going to change things? Also, upcoming student loan repayments. Student loan payments haven't been required for a few years now. That's about to change. Student loan payments are about to resume. That could very well weigh on consumers. But as I said, there's also a lot of positives. Looking at our good news, business spending has held up. Businesses are continuing to spend money. A lot of that is the tail end of inflation. They've tended to protect their balance sheets well. There is some manufacturing spending that's still going on. Consumers are supported by solid job growth, rising real wages. So all of our employees are still making more money than they were previously. Important to know for them to be able to preserve their purchasing power post-pandemic, post-inflation, and the housing market has stabilized a little bit, kind of at lower levels. There is a tight supply of housing still, but all of those things are kind of good signs for the economy. Of there's no significant cracks yet, at least. Overall economy should continue to grow at its moderate pace that it's been at. We're a little below trend growth. Obviously, the onset of the pandemic is a pretty noticeable outlier here. We bounced back to trendline growth pretty quickly after that, and it's just about monitoring our data going forward. Can we continue to grow at this moderate but slowing pace from here? If we're a slower moving economy, if we are at trend, if we're below trend, that is an economy that is increasingly more sensitive to any kind of shocks. Indicates possibility of a future recession. So quick point on the labor market. And next slide is wages, pretty closely tied into the labor market. The unemployment is very, very low, near historic lows. Overall, job gains have occurred since the pandemic. The pace of those job gains has slowed a little bit, seemingly kind of getting back a little bit more to normal. Labor force participation, which is up here on the right. Labor force participation for at least this subset of the population, which is 25 to 54-year-olds, has fully recovered to pre-pandemic levels. Very noticeably different is this subset of the population, which is 55 and over, has absolutely not recovered. And a lot of what that is just the baby boomer generation. If they needed a reason to retire, the pandemic, for a lot of them, just gave them that perfect reason to step away. Not wanting to deal with work anymore after that, not wanting to have a remote environment at the onset of the pandemic. As we saw by the end of 2020 and in 2021, equity markets were fine, using that as a good, jumping off point to retirement. And so aging demographics, when we talk about like, hey, the labor supply and what could that mean for unemployment and what does that mean for the structure of our overall labor market, that baby boomer generation having officially retired in a much larger degree post-pandemic very much reduces the overall supply of labor. And what that does is that when we're looking at our unemployment rate, 50-year average is a little bit over 6%. With where we are today is 3.8. It's going to be really difficult for that unemployment rate to increase back to previous recessionary levels. For sure, 10%. Early 90s, 7.8, because all of those baby boomers, 55 plus generation that never returned to the labor force, there's just a structural shortage of workers in the US going forward. It's just the nature of changing demographics. Even today, there's still 1.5 jobs open and available seeking to hire for every one worker looking for a job. And so, as I mentioned before, unemployment is a pretty important indicator as it pertains to recessions and are we in a recession, are we not in a recession, everything like that. I've read a lot of economists that say structurally, and I think this is rosy, structurally, it may be possible for unemployment to ever get above 5% again, just because of how much our demographics have changed. I think more realistic. There are a lot more economists that say, hey, the average unemployment rate over the last 50 years has been about 6%, 6.2%. That more realistically, a lot of economists think that it will be tough to get above 6% again, just with the structural change to the labor market and changing demographics. Wages, the other component of this is wage growth. The wage growth that we are still seeing today is largely not a concern for keeping inflation levels where they are. We'll talk about inflation briefly on the next slide. The current wage growth is more so after the fact trying to compensate workers for the really high inflation that we had from 2020 through the end of 21, 22. It's kind of a lagged effect to say, hey, costs increased way more than their wages did during those periods. Wage growth has continued to stay a little high. Not too much of a concern for wages themselves contributing to more inflation going forward. It's very much just a tail end effect of hey, their wages wages overall did not rise as fast as inflation did, kind of trying to continue to make up for that fact now that, as we see here, inflation has dropped off meaningfully. Overall headline CPI, consumer price index, peaked at an annual rate of 9.1%. And that was in June last year. And it is now down to 3.7% on an annualized basis at the end of September. When we look at the contributors to CPI, shelter is a big one. As you can see here, shelter is about 65% of the overall contribution to inflation. Shelter is not too volatile, as you can see here, but it's increasing and it's sticky, where we do just have a structural shortage of housing, particularly affordable housing. And so it's tough for that shelter component to change quickly, like everything else changed quickly when supply chain concerns post-pandemic stopped being an issue, stuff like that. And so when we look at the contributors to inflation and we exclude shelter, it is largely still just a lag effect of transportation services, which is largely autos. The auto manufacturers had considerable supply chain issues during the pandemic. That lagged for a long time, and it's still elevated, but it is starting to improve. It started to improve about 5-6 months ago. So now, we've talked about equity markets, we've talked about fixed income markets, we've talked about the economy, what they've done over the last quarter, what they've done year to date, where they stand today, what the foreseeable future might look like. And so taking all of that together and looking at, well, what are the implications for investors of all of those data points that we just talked about? We're going to look at market timing a recession and why you shouldn't try to do that. We're going to talk about putting cash to work when we talked about the skew and valuation measures as it pertains to fixed income markets. Our cash and our money markets and our CDs are paying us a little bit more than everything else, but there's a much bigger story to that than let me get the highest yield that I can today and focusing only on that. Asset allocation of relative valuations, taking all those relative valuations and how that impacts the actual asset allocation of your portfolio. what do you have in stocks? What do you have in bonds? Of your stocks, what's in the US? What's international? What's in value-focused companies? Which companies have attractive price to earnings multiples versus your tech company exposure that have very high price to earnings multiples? Making sure we're considering our asset allocation with all that information. And then lastly, staying focused on being invested in the long term. So as it pertains to market timing recessions, a question we've been getting a lot is clients wondering if they should change their investment strategy in preparation for a possible upcoming recession. And we discourage that. When we come up with an investment strategy, it's more so based off of what are your long-term goals, very much balancing your short-term cash needs, short-term distribution needs. But an asset allocation is very much long-term. We don't like to try and time market events, economic events. And the Great Financial Crisis shows a really good example of why we don't want to do this. So by the time that the recession was actually announced, there very much was a deep recession during the Great Financial Crisis. We didn't know if our financial markets were going to collapse. Banks were collapsing. It was problematic. But by the time the recession was announced, which was in, December of 2008. By the time it was announced that we were in a recession, we were a year into that recession. Recession determinations are by nature backwards looking. So by the time the recession was actually announced, we'd already been in a recession for 12 months. And at that point in time, stocks had already dropped 40%. And so when we look at someone now saying, oh, well, if they're about to say, hey, we're close to a recession, is that my time to make a change in investment portfolio? By the time a recession is announced, it's so far into the recession that it's very difficult to time. Because on the back end, by the time that the end of the recession, if you were going to say, all right, well, I'm going to get out of stocks when the recession is announced, and I'm going to get back in when the end is announced, and I'm going to stay out of the recession that way. By the time that the announcement of the end of the recession happened, it was 18 months after the end of the actual recession. And from the day that the recession was announced, that it had started, to the day that it was announced that it ended, equity markets were up 40% during that time frame. And so just looking at the backwards nature of recessions, by the time we know we're in one, we've been in it for a while. By the time we know we're out of it, we've been out of it for a while. And equity markets are going to do whatever they want to do in the intermediate term there. Correctly predicting that and timing that is very, very unlikely. So aside that a little bit more, is consumer confidence. We think that the questions about changing strategy to avoid a recession, a lot of that is just the general gloomy nature of investors right now. It just seems like there's so much uncertainty. There's political turmoil. The left and right are farther apart than they've ever been. Very much we let that impact our emotions as it pertains to investing. And what this chart shows us here is that when consumer confidence, consumer sentiment is at its worst, it's generally a pretty good time to invest. When consumer sentiment is at its highest, it's not a bad time to invest. It's just not as historically profitable as the trough. And so looking back to 1971, there have been 9 sentiment troughs where sentiment bottomed before recovering, before people getting excited again. And on average, the next 12 months returned to 24% in equity markets. Whenever sentiment peaked, people were feeling at their best. Optimism was at its highest before some kind of change. The 12-month following return was 3.5%. So just another indicator of we don't want to let our belief on when a recession might happen or our general belief on sentiment or how things are looking, how we feel the market is going to do. We do not want to let those impact our investment decisions. Looking at our CD rates and money market rates and how they earn a little bit more today than our 5-year bonds, our 10-year bonds, our 20-year bonds. We don't want to be short-sighted because a 6-month CD, a 1-year CD pays more than US government 10-year, 20, 30-year bonds do. But that's still only a snapshot of today. The main cost that we don't see is the opportunity cost of CDs. What this chart shows us is that when the CD rates have peaked, which you can never know until after the fact anyways, so I wouldn't say that our CD rates have peaked, but they've very much come up quite a bit. Looking backwards at the peak CD rate for 6-month CDs, what the return for the following for the following 12 months was of rolling those 6-month CDs, and comparing it to the average 12-month return for US bonds, for investment grade bonds, for high yield bonds, and for the S&P 500. Historically, when CD rates have peaked, being invested in CDs for that following 12 months was not the best investment option. And a lot of that goes back to the structure of the fixed income markets. Yes, CDs and money markets and short-term rates were the fastest to rise. They'll also be the fastest to fall as rates fall, as when interest rates decline again. And if we're long-term investors, I'd happily give up 0.5% return for the next 12 months, taking 4.5% for a 10-year bond as opposed to 5% for a money market fund or a CD. If 1 year from now, I was still earning 4.5% on my 10-year bond, and I had 9 more years of earning 4.5% to look forward. And in that time frame, rates have fallen, and money markets and CDs are paying 2.5%, 3%. And that's all just illustrated here of when CD rates peak, it's indicative of being at the end of a rate hiking cycle. Yes, at that one point in time, looking at the absolute short term, 5.5% is more than 5. And a lot of people say, hey, I'm just going to go with whatever's paying the most right now. And there can be considerable opportunity costs, which is just, hey, you got to put your capital somewhere. If you allocate it into CDs and you miss out on returns in other asset classes, that is a cost in and of itself. It's an opportunity cost. For long-term investors, we very much need to be mindful of that. We've talked a lot about valuations. This is something that we monitor regularly, which is looking at all of the world asset classes that we want all of our clients to be invested in. And from a standard deviations perspective, hey, what's the normal valuation metric? Which of these asset classes are trading high, which is the right side of our chart? Which of the ones are trading at low valuations, which is theoretically more attractive? And when we're making asset allocation decisions, we want to be mindful of it. Bonds, with the exception of high yield, investment grade bonds are all very attractive, and it's because yields and prices have an inverse relationship as it pertains to bonds. As rates rise, prices fall. And so on the flip side of things, after prices have fallen and our valuations are low, our valuations are attractive because now we have new higher rates that we can take advantage of going forward. We see the difference between US growth, which is at a less elevated valuation than the end of 2021, but still high relative to its average valuation. And we compare that to something like developed international markets, emerging markets, small companies, value companies, all of which are trading at slight discounts to their average valuations, all things that we want to be mindful of when we're making our asset allocation decisions. The real quick talking point on this goes along with the opportunity cost as well. And it says, hey, 5.5% for the next year sounds pretty attractive. Why would I want to be in anything else? I'm worried. Client says, I'm worried about stocks. What if stocks go down 30% next year? I don't want to participate in that. This chart is our reasoning behind still wanting to be invested in something that has the possibility of declining 40% next year. And what this indicates for us is that the longer the time frame that you are investing, the tighter the dispersion is of those asset classes. If you look at any one single rolling 12-month period, stocks can be down 39% and they can be up 47%. There is a very wide dispersion on what can happen in any 12-month period for US stocks. Bonds are historically a little less volatile. They've risen 43% in a 12-month period before. They've fallen 13%, which was last year. And as we see for each of those asset classes, the gray here is a 50-50 portfolio that has a little bit of both of them. The longer the time frame that you're investing, the higher the likelihood there is of you having a positive return. The reason that we like owning a 50-50 portfolio, some stocks, some bonds, particularly when somebody is heading towards retirement, is that historically a 50-50 portfolio has never lost money on any 5-year rolling period, 10-year rolling period, or 20-year rolling year period. Even stocks, I mean, stocks are volatile, but the worst 5-year rolling period was losing 3% a year for 5 years, down 3%. Bonds, they've had a down 2% a year for 5-year period. But you combine both of these asset classes, these worst case scenarios have never occurred on the same 5 years for 5 years. And that's the benefit of a diversified portfolio. So when we have someone stepping off into retirement and there is, very much reasonable concern for stock market volatility, for economic concerns going forward, when we build a diversified portfolio, it's with this concept in mind. If there's only been one 10-year rolling period where stocks haven't provided us a positive return, well, if I've got 40% of my portfolio in something that has never lost money over a 10-year period, and I'm distributing 4% off of my portfolio, I have 10 years worth of distributions in something that has never lost money over 10 years. That gives you a lot of freedom to take the other 60% of your portfolio and have it in equity markets that return on average the most, given the long enough time frame. All just additional context for the benefits of a diversified portfolio. And then our last thing, since I'm running over as is for today, is what I call our shopping list. The things that we're looking at today, just in case we need them. We need to change up our allocations. We need to look into something new, given economic conditions 12 months from now. Diversified sources of income. We want to look more than ever at dividend-paying stocks, equity income type strategies. Our intentional allocation within equities is very much tied into the relative valuation story and saying, hey, some things look pretty expensive, some things look relatively pretty cheap. Let's be mindful of how much of each of those that we own when we build an asset allocation. We're evaluating that today in case we need to make a change 12 months from now. Kind of a build off of diversified sources of income is fixed income outside of treasuries. We spend a lot of time talking about treasury yields just because they're the basis for all other yields. Your corporate bonds are going to pay you more than treasuries because corporations are technically a little riskier than the government. The government can print its own money and corporations can't. And so having treasury yields are always lower than everything else. Institutions, pensions, endowments, institutions that have mandates are often required to own a lot of government debt. But government debt may be overkill for a lot of just normal investors like us. Higher yields than you get with treasuries, but still hold very low default risk overall, still being investment grade. That's what we're looking at going forward. Not quite true high yield, low rated junk bond type debt because the valuations still aren't quite where we want them to be, as we discussed earlier. But we're very much reevaluating the purpose of treasuries in our fixed income portfolio if more yield exists elsewhere. And then lastly, looking at real estate. We mentioned when it comes to shelter component of CPI, there is just a shortage of affordable housing and real estate. For us, that means looking at multifamily type real estate investments. Are valuations still attractive enough there, adjusted for new higher interest rates? That part of inflation being rising rents, can we take advantage of that in some way? From a real estate perspective, it's largely looking at industrial properties as well. Same structural shortages exist for industrial as compared to multifamily. So that is it for our presentation today. I had told Jim that I didn't even have that much to talk about today, and I think this is the longest presentation I've given in over a year. So I appreciate your patience today, and I appreciate you joining us for our presentation. Please feel free to reach out. I spent a lot of time with my disclaimers here saying that hey, this is just general information. This is no guarantee of future considerations. Individual investors are still so unique that oftentimes a lot of this general information just doesn't apply. And so here's some more information on how to reach us for questions for existing clients. We work as an ensemble. We're always here to answer questions. You can pick up the phone and call any one of us. You can send an email to any one of us. If this presentation sparked any questions, concerns, we very much want to hear them. That's what we're here for.
Awesome. Thank you very much, Nathan. And thank you guys for attending. We'll have a recording available and we'll be distributing that to you all as well for being here today. And if you want to check us out on YouTube, it's available there for you to share with anyone who might have missed it or you think might benefit from this conversation as well. Thanks, guys. Have a great day.